Hello friends. Welcome back to Undergraduate, freshman session. So today we are going to start a new course of this session, which is Trading the News. In this session we have below lessons. News makes the Forex market move. Be careful trading the news. Which news releases should I trade? 2 ways to trade the news. How to trade the news with a directional bias. How to trade the news using the straddle trade strategy. And summary of trading the news. So let's start with first lesson. News makes the Forex market move. It's not enough to only know technical analysis when you trade. It's just as important to know what makes the Forex market move. Just like in the great Star Wars world, behind the trend lines, double tops, and head and shoulder patterns, there is a fundamental force behind these movements. This force is called the news. To understand the importance of the news, imagine this scenario. Purely fictional, of course. Let's say, on your nightly news, there is a report that the biggest software company just filed bankruptcy. You own shares of this company. What's the first thing you would do? How would your perception of this company change? How do you think other people's perceptions of this company would change? The obvious reaction would be that you would immediately sell off your shares. In fact, this is probably what just about everyone else who had any stake in that company would do. The fact is that news affects the way we perceive and act on our trading decisions. It's no different when it comes to trading currencies. There is, however, a distinct difference with how news is handled in the stock market and the Forex market. Let's go back to our example above and imagine that you heard that same report of the big software company filing bankruptcy, but let's say you heard the report a day before it was actually announced in the news. Naturally, you would sell off all your shares, and as a result of you hearing the news a day earlier, you would save more money than everyone else who heard it on their nightly news. Sounds good for you, right? Unfortunately, this little trick is called insider trading, and it would have you thrown in jail. Martha Stewart did it, and now she has a nice mugshot to go along with her magazine covers. In the stock market, when you hear news before everyone else, it is illegal. In the Forex market, it's called fair game. The earlier you hear or see the news, the better it is for your trading, and there is absolutely no penalty for it. Add on some technology and the power of instant communication, and what you have is the latest and greatest, or not so greatest, news at the tip of your fingers. This is great. News for retail traders because it allows us to react fairly quickly to the market's speculations. Big traders, small traders, husky traders, or skinny traders all have to depend on the same news to make the market move, because if there wasn't any news, the market would hardly move at all. The news is important to the Forex market because it's the news that makes it move. Regardless of the technicals, news is the fuel that keeps the Forex market going. Let's come to the next topic. Be careful trading the news. Why trade the news? The simple answer to that question is to make more money. But in all seriousness, as we learned in the previous section, the news is a very important part of the Forex market because it has the potential to make it move. When news comes out, especially important news that everyone is watching, you can almost expect to see some major movement. Your goal as a Forex trader is to get on the right side of the move, but the fact that you know the market will most likely move somewhere makes it an opportunity definitely worth looking at. Dangers of trading the news. As with any trading strategy, there are always possible dangers that you should be aware of. Here are some of those dangers. Spreads widen. Because the Forex market is very volatile during important news events, many Forex brokers widen the spread during these times. This increases trading costs and could hurt your bottom line. You could also get locked out, which means that your trade could be executed at the right time but may not show up in your trading station for a few minutes. This is bad for you because you won't be able to make any adjustments if the trade moves against you. Imagine thinking you didn't get triggered, so you try to enter at market. Then you realize that your original order got triggered. You'd be risking twice as much now. Price slippage. You could also experience slippage. Slippage occurs when you wish to enter the market at a certain price, but due to the extreme volatility during these events, you actually get filled at a far different price. Big market moves made by news events often don't move in one direction. Oftentimes the market may start off flying in one direction, only to be whipsawed back in the other direction. Trying to find the right direction can sometimes be a headache. Profitable as it may be, trading the news isn't as easy as beating Pip Crawler at Call of Duty. It will take tons of practice, Practice, and you guessed it. More practice. Most importantly, you must always have a plan in place. In the following lessons, we'll give you some tips on how to trade news reports. Let's move into the another topic: which news releases should I trade? Before we even look at strategies for trading news events, we have to look at which news events are even worth trading. Remember that we are trading the news because of its ability to increase volatility in the short term, so naturally, we would like to only trade news that has the best forex market moving potential. While the markets react to most economic news from various countries, the biggest movers and most watched news come from the US. The reason is that the US has the largest economy in the world, and the US dollar is the world's reserve currency. This means that the US dollar is a participant in about 90% of all forex transactions, which makes US news and data important to watch. With that said, let's take a look at some of the most volatile news for the US. In addition to inflation reports and central bank talks, you should also pay attention to geopolitical news such as war, natural disasters, political unrest, and elections. Although these may not have as big an impact as the other news, it's still worth paying attention to them. When our economic guru Forex Gump is in a good mood, he usually releases an article on upcoming news reports that you can play in with trade strategies to boot. Check out some of his articles of this sort. Trade the news this week. 4 news reports you can trade this week. Trade the US retail sales report with me. Make pips with this week's big reports. Also, keep an eye on moves in the stock market. There are times where sentiment in the equity markets will be the precursor to major moves in the forex market. Now that we know which news events make the most moves, our next step is to determine which currency pairs are worth trading. Because news can bring increased volatility in the forex market, and more trading opportunities, it is important that we trade currencies that are liquid. Liquid currency pairs give us a reassurance that our orders will be executed smoothly and without any hiccups. Euro to US dollar. Pound sterling to US dollar. US dollar to Japanese yen. US dollar to Swiss franc. US dollar to Canadian dollar. Australian dollar to US dollar. Did you notice anything here? That's right. These are all major currency pairs. Remember, because they have the most liquidity, major pairs usually have the tightest spreads. Since spreads widen when news reports come out, it makes sense to stick with those pairs that have the tightest spreads, to begin with. Now that we know which news events and currency pairs to trade, let's take a look at some approaches to trading the news. Let me tell you 2 ways to trade the news. There are 2 main ways to trade the news. A. Having a directional bias. B. Having a non-directional bias. Directional bias. Having directional bias means that you expect the market to move a certain direction once the news report is released. When looking for a trade opportunity in a certain direction, it is good to know what it is about news reports that will cause the market to move. Consensus versus actual number. Several days or even weeks before a news report comes out, there are analysts that will come up with some kind of forecast on what numbers will be released. As we talked about in a previous lesson, this number will be different among various analysts, but in general, there will be a common number that a majority of them agree on. This number is called a consensus. When a news report is released, the number that is given is called the actual number. Buy the rumors, sell on the news. This is a common phrase used in the forex market because oftentimes it seems that when a news report is released, the movement doesn't match what the report would lead you to believe. For example, let's say that the US unemployment rate is expected to increase. Imagine that last month the unemployment rate was at 8.8% and the consensus for this upcoming report is 9.0%. With a consensus at 9.0%, it means that all the big market players are anticipating a weaker US economy, and as a result, a weaker dollar. So with this anticipation, big market players aren't going to wait until the report is actually released to start acting on taking a position. They will go ahead and start selling off their dollars for other currencies before the actual number is released. Now let's say that the actual unemployment rate is released and is expected, it reports 9.0%. As a retail trader, you see this and think, okay, this is bad news for the US, it's time to short the dollar. However, when you go to your trading platform to start selling the dollar, you see that the markets aren't exactly moving in the direction you thought it would. It's actually moving up. What the heck? Why? This is because the big players have already adjusted their positions way before the news report even came out and may now be taking profits after the run-up to the news event. Now let's revisit this example, but this time, imagine that the actual report released an unemployment rate of 8%. The market players thought the unemployment rate would rise to 9% because of consensus. But instead, the report showed that the rate actually decreased, showing strength for the dollar. What you would see on your charts would be a huge dollar rally across the board because the big market players didn't expect this to happen. Now that the report is released and it says something totally different from what they had anticipated, they are all trying to adjust their positions as fast as possible. This would also happen if the actual report released an unemployment rate of 10.0%. The only difference would be that instead of the dollar rallying, it would drop like a rock. Since the market consensus was 9.0% but the actual report showed a bigger 10.0% unemployment rate, the big players would sell off more of their dollars because the US looks a lot weaker now than when the forecasts were first released. It's important to keep track of the market consensus and the actual numbers. You can better gauge which news reports will actually cause the market to move and in what direction. Non-directional bias. A more common news trading strategy is the non-directional bias approach. This method disregards a directional bias and simply plays on the fact that a big news report will create a big move. It doesn't matter which way the forex market moves. We just want to be there when it does. What this means is that once the market moves in either direction, you have a plan in place to enter that trade. You don't have any bias as to whether the price will go up or down, hence the name non-directional bias. Let's come to the another topic. How to trade the news with a directional bias. Let's now see how to trade the news with a directional bias in a trading scenario. Let's go back to our example of the U.S. unemployment rate report. Scenario: if the U.S. unemployment report showed improvement, why did USD still weaken? Earlier, we gave examples of what could happen if the unemployment report came in line with expectations, or slightly better. In this scenario, let's say the unemployment rate showed a surprising drop. Which is a good thing since that means more people now have jobs. But you look at your charts and the dollar is falling. What? Isn't the dollar supposed to rise if the unemployment rate is dropping? There could be a couple reasons why the dollar could still fall even though there are more people with jobs. Reason number 1, overall economic outlook still poor. The first reason could be that the long-term and overall trend of the U.S. economy is still in a downward spiral. Remember that there are several fundamental factors that play into an economy's strength or weakness. Although the unemployment rate dropped, it might not be a big enough catalyst for the big traders to start changing their perception of the dollar. Reason number 2, positive employment numbers are temporary. Perhaps it's right after Thanksgiving during the holiday rush. During this time, many companies normally hire seasonal employees to keep up with the influx of Christmas shoppers. This increase in jobs may cause a short-term drop in the unemployment rate, but it's not at all indicative of the long-term outlook for the U.S. economy. A better way to get a more accurate measure of the unemployment situation would be to look at the number from last year and compare it to this year. This would allow you to see if the job market actually improved or not. The important thing to remember is to always take a step back and look at the overall picture before making any quick decisions. Now that you have that information in your head, it's time to see how we can trade the news with a directional bias. How to trade the news with a directional bias. Let's stick with our unemployment rate example to keep it simple. The first thing you would want to do before the report comes out is to take a look at the trend of the unemployment rate to see if it has been increasing or decreasing. By looking at what has been happening in the past, you can prepare yourself for what might happen in the future. Imagine that the unemployment rate has been steadily increasing. 6 months ago it was at 1% and last month it topped out at 3%. You could now say with some confidence that jobs are decreasing and that there is a good possibility the unemployment rate will continue to rise. Since you are expecting the unemployment rate to rise, you can now start preparing to go short on the dollar. This is your directional bias. Particularly, you feel like you could short US dollar to Japanese yen. Just before the unemployment rate is about to be announced, you could look at the price movement of US dollar to Japanese yen at least 20 minutes prior and find the range of movement. Take note of the high and low that is made. This will become your breakout points. Since you have a bearish outlook on the dollar, your directional bias, you would pay particular attention to the lower breakout point of that range. You are expecting the dollar to drop, so a reasonable strategy would be to set an entry point a few pips below that level. You could then set a stop just at the upper breakout point and set your limit for the same amount of pips as the breakout point range. One of two things could happen at this point. If the unemployment rate drops, then the dollar could rise. This would cause US dollar to Japanese yen to rise and your trade would most likely not trigger. No harm, no foul. Or if the news is as you expected and the unemployment rate rises, the dollar could drop, assuming the entire fundamental outlook on the dollar is already bearish. This is good for you because you already set up a trade that was bearish on the dollar and now all you have to do is watch your trade unfold. Later on, you see that your target gets hit. You just grabbed yourself a handful of pips. Booyah! The key to having a directional bias is that you must truly understand the concepts behind the news report that you plan to trade. If you don't understand what effect it can have on particular currencies, then you might get caught up in some bad setups. How to trade the news using the straddle trade strategy. What if there was a way to make money quickly even if you had no idea whether the market would move up or down? It's possible as long as there is sufficient price volatility. And when can you get this volatility? When news like economic data or central bank announcements is released. The first thing to consider is which news reports to trade. Earlier, we discussed the biggest moving news releases. Ideally, you would want to only trade those reports because there is a high probability the market will make a big move after their release. The next thing you should do is take a look at the range at least 20 minutes before the actual news release. The high of that range will be your upper breakout point, and the low of that range will be your lower breakout point. Note that the smaller the range is, the more likely it is you will see a big move from the news report. The breakout points will be your entry levels. This is where you want to set your orders. Your stops should be placed approximately 20 pips below and above the breakout points, and your initial target should be about the same as the range of the breakout levels. Straddle trade. This is known as a straddle trade. You are looking to play both sides of the trades. It doesn't matter which direction the price moves, the straddle strategy will have you positioned to take advantage of it. Now that you're prepared to enter the market in either direction, all you have to do is wait for the news to come out. Sometimes you may get triggered in one direction only to find that you get stopped out because the price quickly reverses in the other direction. However, your other entry will get triggered, and if that trade wins, you should recoup your initial losses and come out with a small profit. A best-case scenario would be that only one of your trades gets triggered and the price continues to move in your favor so that you don't incur any losses. Either way, if done correctly, you should still end up positive for the day. One thing that makes a non-directional bias approach attractive is that it eliminates any emotions. You just want to profit when the move happens. This allows you to take advantage of more trading opportunities because you will be triggered either way. There are many more strategies for trading the news, but the concepts mentioned in this lesson should always be part of your routine whenever you are working out an approach to taking advantage of news report movements. Summary: trading the news. When trading the news, you can either have a directional bias or a non-directional bias. Here are some other things to keep in mind when news trading. When you have a directional bias, you are expecting price to move a certain direction, and you've got your orders in already. It is always good to understand the underlying reasons why the market moves in a certain direction when news is released. When you have a non-directional bias, you don't care which way price heads. You just want to get triggered. Setups for the non-directional bias are also called straddle trades. That's pretty much it. Is it really that easy? Heck no. You'll have to practice and trade many different reports before you get a feel for which news reports will make the market move. How much of a surprise is needed for the market to move? Which reports to avoid trading? Like in any other trading method, your success depends on your preparation. Remember, nothing worth having comes easy, so stick with it and you'll find that trading the news will be very rewarding once you get the hang of it. So guys, this course is completed here. In next video we will cover last course of this session, which is carry trade. So stay tuned.